Hey, welcome back, everybody, to Budget with Me. My name is Josh. So, we're going to continue building on that last video about the velocity banking puzzle. This is the weekly spreadsheet. And if you've watched the other videos, I already showed you how to do the monthly budget, which gives you all of your dollars in, all of your dollars out, so you know what your fixed and variable expenses are. So on the weekly side, when we plug all this in, the weekly is where we can do the projections per paycheck, and you can go out as far as you'd like. I've only got 4 here to show you an example. Me personally, I go out a whole year. So on the weekly side, we've got all of our expenses, but with velocity banking, and I heard somebody say this in another video, another YouTuber I was watching, that putting velocity banking out there is like financial evangelism. And I thought that was really an interesting way to put that because it is a different way of thinking. It's not what we were all taught. And I'm doing this along with other people that are sharing this on YouTube because I think it's very important that people understand that are in lots of debt and have issues getting out of it. That velocity banking is something that can help you, really increase the size of your shovel. And I mean that by, if you have a line of credit, you can take all of your expenses out that you know are month to month out of the line of credit. And then all month long, when you get paid, you can put your entire income back into that line. And the idea is that you're using a tool that is simple interest versus going out and taking a loan, which is what the banks want you to do. If you take out a loan, like you get advertisements or emails all the time that might say, hey, you're pre-approved for a loan at so-and-so bank, and it's, only 13% interest or something like that. Banks always steer you towards a loan because it's front-loaded interest. And every time you make that loan payment, that money's gone. You can't use it again because you're paying the loan back. In a line of credit, it's simple interest based on the average daily balance. So if you're depositing your income back into the line, if you get paid every week or you get paid twice a week, it doesn't matter. Every time you make a deposit back into the line, you're affecting the average daily balance, which will effectively reduce your interest that you pay. And it's much easier to calculate than you might think. So the idea is that your fixed expenses, are one thing. Let's say, in this example I'm showing you, it's $59.89 is total expenses. Okay. Total income for this person is only $6,000. So the first step is we don't want to just take, the 6,000 or the 59.89 that we need out of like a HELOC or a line of credit and then turn around and deposit in only 6,000 because that's only giving us an $11 spread where we're reducing that line of credit. So the first step for this person is on the first page. We found out that credit card 1 has a balance of $72.50, and that minimum payment for that card is $376 a month. All right, so the line of credit that we got approved for was $40,000 because this person has a mortgage. And we know from credit, from the CFI, the cash flow index, that 376 for 7250 is the most attractive one to pay off first and then work the balance down. So cash flow index, I've talked about that in other videos. That's you take the total balance of whatever the card is or the loan is, and you divide it in to the minimum payment, and that gives us a score. It's usually a 2 to 3 digit score. If that score is under 50, it's the most attractive one to pay off based on all your other debts. This one is a 19. So our line of credit was 40,000, and we can start small on this. So 40,000, we take all of our expenses, which is the 59.89 plus the 7250 balance, and we put both of those items into the HELOC, or we take a withdrawal from the HELOC totaling those amounts. So 59 plus the 7250, and that's going to be, forgot the equal sign here, that's going to be 13,239 is our first pull that we take out of the line. And that would go into your weekly deposit, 13,239. And then down here, let's, in this example, this is November 1st paycheck. So we just took our income here. And then we also got our paycheck of $1,500. So the first thing we do, once the money went in, now our HELOC balance is the 13,289 on day one. And we're going to pay off that credit card right here because it went into the HELOC. That causes this minimum payment now to be satisfied. It's zero. Okay. Then we're going to pay all of our other expenses throughout the month. The first thing that we do when we get paid is we're going to take that income and we're going to pay it right into the HELOC. So, if this all happened on November 1st, day one, you took out the HELOC to pay all of your expenses and this first credit card to eliminate that minimum payment. Now your cash flow is minus 376. So instead of it being 59.89, your minimum expenses for the month are 56.13. So the difference there is going to effectively reduce our HELOC balance every month as we continue to do this. Once we get the HELOC paid down to zero, which won't take very long because we're paying $500 or $450 at a time, and we're reducing interest, we'll go and look at the cash flow index and take the next thing in. Now, alternatively, let's talk to the argument of, okay, well, why would I want to do that when I could just pay extra into my credit card and not take the HELOC? Because the credit card is a much higher interest rate of, let's say, 30%, maybe 20, 28%, something like that. And you can't pay everything with a credit card the way you can with a HELOC. So it causes your shovel to be smaller, basically. Since I can't put all of my expenses, including my mortgage and my car payment, into the credit card, I'm not effectively able to make a larger income deposit into the credit card. So it makes me pay it slower rather than me just saying, okay, well, then I'll just take $400 and I'll add it to the minimum payment. And now I'm making, the $775 minimum payment. Well, that's great. But where is that $400 going to come from? Because this person was maxed out. They only had $11 cash flow. So I hope that makes sense. I'm going to talk about this a little bit more, but I think it's a very exciting thing. I know it is. I know it's helped me. It's helped a lot of other people I've talked to. So if you like these videos at all, please like and subscribe. Give me some comments or something. Let me know what I'm doing right or wrong. I appreciate you watching. Have a good day.